If you think the stock market is falling because investors calmly woke up one morning and changed their minds, you are reading a machine event as though it were a human conversation. That is the first mistake. And in a market like this, the first mistake is usually the one that empties the account. Most people still imagine a market decline as something emotional but basically organic. Investors get nervous, they sell, prices fall, bargain hunters step in, the market finds a floor. It sounds civilized, it sounds almost reasonable. That is not the tape we are dealing with right now. What we are dealing with now is a reflexive chain. Machines sell. Their selling worsens price. Worse price triggers more selling. More selling hits thin liquidity. Thin liquidity creates larger moves. Larger moves lift volatility. Higher volatility triggers another class of machines. Those machines sell too. Then the ordinary investor looks at the screen and says, "The market must know something terrible," and he joins the very avalanche he never bothered to understand. That is how modern drawdowns work when the plumbing gets stressed. And if you do not understand the plumbing, you will make the oldest mistake in the book. You will act on the symptom and miss the mechanism. I have no interest in that kind of investing. I do not want to be a tourist in a market driven by rules I have not bothered to learn. I want to know who is selling, why they are selling, what forces them to sell more, and what would have to happen before that machine begins exhausting itself. That is the real work. Not predicting the exact bottom with a magician's flourish. Not memorizing some slogan about buying fear. Certainly not confusing activity with understanding. Real money in a market like this does not go to the man with the best one-liner. It goes to the man who can tell the difference between a valuation event, a macro event, and a forced flow event. This right here is a forced flow event. That is the mother line. Say it to yourself until it begins changing how you look at the screen, a forced flow event, because once you understand that, the market stops looking random and starts looking dangerous in a very specific way. It becomes dangerous not because the businesses underneath it all simultaneously changed overnight. It becomes dangerous because the market structure can temporarily overpower the market's judgment. That distinction matters. A stock price can move for one of at least three reasons. The business changed, the discount rate changed, or the ownership structure changed because somebody had to move inventory. Most investors spend all their time on the first two and barely understand the third. That is why they keep getting blindsided when the third one takes over. Now, I want to frame this in the language that has always made the most sense to me. If I buy a farm, I do not care whether somebody else had to pawn his watch on Thursday afternoon. If I buy a candy company, I do not care whether an options dealer was forced to hedge into weakness for 3 sessions in a row. But if I am watching a listed market and trying to survive the path between today's price and tomorrow's value, then I must care very much about who is being forced to transact and under what rules. That is not speculation. That is respect for the arena. A man can know exactly what a business is worth in the long run and still lose a lot of money in the short run if he is blind to how forced flows can distort the tape. That is what many people are relearning right now. So let us talk about the first mechanism. I call it threshold selling. A lot of machine money is not actually thinking. It is measuring. That is the whole game. It is watching for level breaks, momentum deterioration, volatility shifts, trend changes, and all the little numerical doors that, once opened, tell the system to do the next thing. Buy here, sell here. Go flat here, go short here. Add if this breaks, reverse if that fails. A man can be forgiven for thinking, this sounds stupid. But a lot of stupid rules acting on huge capital can be more powerful than smart people with good intentions. That is the danger. The machines do not need to be wise. They only need to be big and synchronized. When a threshold breaks, they do not pause to ask if the selling is fair. They do not care that a business is wonderful. They do not care that a stock is already down a lot. They only know the rule, and the rule says sell. That is why so many drawdowns feel air-pocketed. Now, you are not dealing with hesitation. You are dealing with programmed conviction. That programmed conviction gets amplified when liquidity is thin. And right now, liquidity is thin enough that medium-sized selling can feel like large-sized fear. That is a terrible combination because a thin market turns measured selling into exaggerated price damage, and exaggerated price damage creates the appearance of information. People say the market must know something. No, often the market just knows its own rules. That is the first thing you need to stop being fooled by. The second mechanism is CTA reflex. People hear that phrase and their eyes glaze over, which is unfortunate. Because if you do not understand trend following systems, at least at a basic level, CTAs are not mystical beings. They are systematic trend followers. When strength persists, they add. When weakness persists, they reduce. When enough downside thresholds break, they can move from long to flat to short. And because they are dealing in large size, once they start moving, their movement itself becomes part of the story. This is one reason markets can feel as though they are The first wave of selling is not merely expressive. It is catalytic. A break triggers machine selling. That selling helps create the next break. The next break invites more selling. And because many of these systems share similar kinds of inputs, what looks like independent judgment is often a coordinated surrender to the same mathematics. That is what people mean when they say the machines are driving the tape. It is not that a robot became bearish in the poetic sense. It is that enough rules were broken in enough places that large pools of money began moving in the same direction at once. Now, I want to say something important here. Just because a market is being mechanically sold does not mean it is automatically cheap. A lot of people hear machine selling and get excited because they imagine they have found free money. That is not how it works. A mechanically sold market can become cheap. It can also become much cheaper before it does. The right lesson is not, the machines are stupid, therefore buy immediately. The right lesson is, the machines may overshoot. Therefore I must understand where the next accelerants are before I decide what kind of owner I want to be. That is a much more serious mindset, which brings us to the third mechanism. Dealer gamma. I know many investors hate the vocabulary of options because it sounds like a different planet, but you do not need to become an options wizard to understand the practical effect. When dealers are short gamma, falling markets can force them to sell more as the market goes lower. That is the line. Not because they are making a philosophical statement about America, because their hedge requirements become increasingly hostile to price stability. A down move can force additional selling. An up move can force additional buying. It creates acceleration. In a quiet, that may not matter much. In a stressed market, it matters enormously. Short gamma is one of the clearest ways modern markets lose their dignity. A small push becomes a bigger move. A bigger move invites more hedging. More hedging sharpens the move again. All of this is happening while ordinary investors are still talking, as if we are simply debating valuation over coffee. That is why I keep emphasizing structure. If the market structure is unstable, your opinion about the market's intrinsic value can be correct, and still poorly timed. That is not a reason to despair. It is a reason to respect path. And if you do not respect path, path will teach you respect with a blunt instrument. Now let us add the fourth mechanism, volatility control. This is where the problem stops being merely large and starts becoming enormous. A great many products in the world are sold on the promise that somebody else will reduce exposure when conditions get scary. That promise sounds comforting to the buyer. It is destabilizing to the market if enough money is tied to it. The logic is simple. If volatility rises beyond certain levels, these strategies cut risk. How do they cut risk? They sell equities, not because they woke up wiser than yesterday, because the rules told them to. This becomes especially dangerous when volatility itself is already being pushed higher by other forces. CTAs sell, dealers sell into weakness. Liquidity is thin. The tape gets uglier. Volatility rises. Vol control strategies begin unwinding. Now you have another enormous source of selling pressure layered on top of the first ones. That is when a bad week becomes a cascade. People do not understand this because they still think of volatility as something that happens after fear. In a market like this, volatility is not just the emotion thermometer. It is a trigger. And triggers linked to large capital pools matter more than opinions on financial television. This is why I always say the market is no longer just a weighing machine or a voting machine. Sometimes it is a reflex machine. The reflexes matter until they exhaust themselves. If you want to survive such a phase, you must think like an engineer before you think like a prophet. Where are the trigger levels? What happens if they break? Who is forced to sell if volatility goes a little higher? Who stops selling if volatility cools down? Those are the questions, not whether somebody on television feels nervous. The fifth mechanism is the dollar lever. This one is criminally underestimated by people who only look at equity charts. The dollar matters because it is one of the central gears in the risk machine. When the dollar firms, global financial conditions often tighten. That alone is enough to create pressure. But it does something else. A stronger dollar can work alongside higher volatility and weaker risk appetite to amplify the selling loop. If CTAs are buying dollars while reducing risk elsewhere, if the dollar is breaking out while volatility is rising, the message is not merely the market is scared. The message is the market's stress channels are beginning to synchronize. That is much more dangerous, because synchronized stress is how small cracks become structural events. A stronger dollar is not always bearish for everything. Of course, nothing in markets is that childish. But in this environment, with mechanical sellers active, thin liquidity, and vol control strategies lurking, dollar strength is gasoline. That is why I care so much about it. Not because I worship the DXY chart, because it tells me whether the storm is getting more orderly or more chaotic. A lot of people love pretending they care only about businesses. Wonderful, when the weather is calm, perhaps they can afford that luxury. When the market is on the cusp of another reflexive leg lower, they had better care about the weather too. The sixth mechanism is liquidity vacuum. This one is easy to explain and painful to experience. If there are not enough natural buyers to absorb selling quickly, price must move farther to find them. That is what thin liquidity means in practice. It means the market is not just vulnerable to bad news, it is vulnerable to size itself. A large sell order in a liquid market is absorbed with less drama. The same order in a thin market becomes a price event. That is where we are. And once the market becomes a price event, people begin trading the damage instead of the underlying businesses. Hedge funds sell, machines sell. Retail loses nerve. Now the floor is not where value lives. The floor is where enough inventory has been cleared to allow the next buyer to breathe. Those are not the same thing. This is why bottoms are so hard to call from the inside. People think a market bottoms because valuation finally becomes compelling, sometimes. But in a force flow environment, a market often bottoms because the sellers are temporarily exhausted, or because a new category of buyer finally arrives with enough size and confidence to matter. That means bottoming is not only a valuation question, it is also a flow question. That distinction saves a lot of pain, because if you only ask, is this cheap enough? You may buy repeatedly into an unexhausted machine. If you ask, have the flows started losing force? You are at least asking the right second question. The seventh mechanism is capitulation layering. This is where human behavior enters and often makes everything worse. The hedge funds have sold, the machines are selling, the dealers are selling, the volatility products may sell. Then, finally, retail begins to sell. That is often the ugliest part psychologically, because it produces the illusion that the market is now seeing some final terrible truth. No, what it is often seeing is layered capitulation. One category sells, then the next, then the next. At each step, the people still holding say, this is irrational, therefore the bottom must be close. Sometimes that is true. Sometimes the next layer has not even started yet. That is why I do not like easy bottom calls in a machine. Driven tape. The better frame is to ask what categories of forced or rule base sellers still have inventory and what would cause them to stop or intensify. That is the adult version of the conversation. I want to pause here and say something very clearly. All of this does not mean the market is doomed. It means the market is currently fragile. Those are different ideas. Fragility is a structural condition. Doom is an emotional slogan. I do not invest on slogans. Fragility can eventually create a very good buying opportunity. But you only get paid if you survive the fragility with enough emotional and financial discipline to keep thinking. That means if you are heavily levered, this is the kind of tape that kills you before you can discover whether your larger thesis was right. If you are overexposed and counting on a quick rebound, this is the kind of tape that teaches you that risk management is not an optional chapter at the back of the book. It is the first chapter always. And this is where I want to make the most important distinction of all. There is a difference between a market getting cheaper and a market becoming safe. People love to collapse those two ideas into one. A market can get cheaper while still being structurally unsafe in the short term because the reflex loops have not finished firing. That is why I do not respect courage that ignores process. I prefer patience with a plan. If the market is being driven lower by short gamma, CTA selling, thin liquidity, dollar strength, and the threat of vol control liquidation, then the right posture is not theatrical bravery. The right posture is prepared opportunism. That means watch lists, cash, predetermined levels, position sizing, an understanding of what genuine evidence of exhaustion would look like, And perhaps most important, a refusal to let boredom talk you into calling the bottom before the tape gives you any reason to believe one is forming. This is where most people fail. They do not fail because they are unintelligent. They fail because they cannot tolerate the space between seeing the opportunity in theory and waiting for the market structure to stop trying to kill them in practice. That space is expensive, and it is exactly where the professionals earn their living. Now, let us talk about what an actual bottom tends to look like in a machine event. It usually does not look like a calm debate among sensible people. It looks like a fight. You see a surge in volume. You see a sign that natural buyers are finally stepping in with size. You see the tape stop behaving as though every downtick must be amplified. You see volatility fail to make a new dramatic high or begin easing. You see selling pressure start to feel less mechanical and more discretionary. You may see a green reversal day with real participation rather than a sleepy bounce on no conviction. That is the kind of evidence I respect, not wishful thinking, not we are down a lot, not it feels terrible. Terrible is not a signal. Terrible is a mood. You need evidence that the market's internal enemies are tiring. That is a much better way to look for an entry. The eighth mechanism is asymmetry of opportunity. This is where the situation becomes interesting instead of merely frightening. When enough machine selling has happened, enough hedge funds have cut, enough retail has thrown in the towel, enough dealers have sold into weakness, and enough volatility, sensitive strategies have either triggered or clearly not triggered, the market can suddenly become much more asymmetric. Why? Because once the reflexes are close to exhaustion, any improvement in the news, any de-escalation in the macro picture, any reduction in the dollar's pressure, any calming in volatility, or any decent economic surprise can force the machines to move the other way, and machines that sell mechanically can also buy mechanically. That is what creates some of the most violent rebounds, not sudden wisdom, rule reversal. This is why the deepest short positioning can actually be a setup for a sharp bounce, if and only if the underlying stress begins to ease. That if is everything. The market right now is standing close to a zone where excessive shorting and excessive fear could create a reversal. But a zone is not a signal. Do not confuse the two. A zone tells you where a reversal could become powerful. A signal tells you the reversal has started to matter. You need both. Otherwise, you are just buying hope. I have no appetite for hope as a strategy. The ninth mechanism is time horizon. This is where people reveal what they actually are. A great many investors talk like owners and behave like renters. They say they are long-term. Then a week like this arrives and suddenly every sentence begins sounding very short. Term indeed, if you are truly long-term and own real businesses or diversified productive assets, then a machine event is not the same thing as a broken thesis. It may still hurt. It may still change near-term decisions. It may still argue for caution in adding too early, but it does not automatically invalidate the long-term case. That is why your time horizon must be honest. If you need the money soon, the tape matters enormously. If you are levered, the tape matters brutally. If you are sizing for decades and can survive the path, then the tape matters differently, not less. Differently, the long-term investor should not ignore machine selling. He should respect it enough to improve his entry timing and protect his psychology. But he should never let a short-term structure event bully him into acting as though a good business became worthless because the machines are temporarily in charge. That is the difference between being informed and being manipulated by the tape. Now, let me tell you what I would do. I would not rush to buy simply because the market is down. I would not panic sell simply because the market structure is ugly. I would first decide what kind of participant I am. If I am short, I would be watching very carefully for any signs that volatility is failing to accelerate and that the market is absorbing bad news better than before. Because the most dangerous thing for a successful short is not being wrong about the trend. It is overstaying once the machine begins tiring. If I am holding cash and looking for entries, I am not trying to be a hero. I am looking for proof. Proof in volume, proof in reversal behavior, proof in volatility, proof in the dollar, proof that the forced sellers are no longer the only serious actors on the field. Until then, patience is not cowardice, it is intelligence. And if I already own a strong core portfolio of quality assets, I am reviewing my risk, my sizing, and my need for liquidity. I am not making emotional decisions based on one bad week. I am making structural decisions based on whether the market is still fragile enough to punish undisciplined additions. That is what an owner does. The 10th mechanism is humility. This may be the most useful word in a tape like this. Humility does not mean fear. It means respect for the fact that a machine-driven market can go farther than your pride wants to allow. It means respecting thresholds you did not invent. It means understanding that the first move, the second move, and the final washout are not always separated by logic that feels fair. It means understanding that if a trillion-dollar class of strategies is close to being triggered, your opinion about what should happen matters less than your preparation for what can happen. That kind of humility protects capital. Vanity destroys it. Now, I want to end with the real question. Not whether the machines are selling. They are. Not whether they can sell more. They can. Not whether the market could break harder if enough thresholds go. It could. The real question is whether you are going to behave like a spectator hypnotized by a modern panic, or like an owner who understands that reflexes burn hot and then burn out. That is the threshold. You can watch the tape and let it tell you that panic is wisdom. You can sell because everybody is selling. You can buy because you are tired of waiting. You can call a bottom because your emotions need one. And if you do, you will be acting exactly the way machine-driven markets teach human beings to act at the wrong moment. Or you can do the harder thing. You can understand the sequence: CTA selling, dealer hedging, thin liquidity, dollar strength, volatility pressure, potential vol, control unwind, capitulation, then maybe exhaustion, then maybe reversal. That is the map. The map does not tell you the exact day, but it keeps you from wandering blindly. And in a market like this, avoiding blindness is already a huge edge, because when the dust does settle, and it always does eventually, the people who kept their structure and their mind will be the ones with the cash, the confidence, and the clarity to act. Everyone else will still be trying to explain why the market felt so unfair. The market is not fair, it is structured. Learn the structure and you stop being surprised by the violence. Respect the structure and you stop donating money to it. That is the contract. Not that markets will be kind. Only that, if you understand the machinery better than the crowd, you do not have to be one more body under the wheels.